looks quiet. Here's something that might change your mind. A single Substack post wiped $50 billion. This news was tracked and brought to you by PIQ, the detailed customizable dashboard that is free for users. Follow them at PIQ Suite on X. How many of you woke up this morning, checked the features, and thought, looks quiet? Here's something that might change your mind. A single Substack post wiped $50 billion from the stock market this week. American Express and Visa, down $20 billion combined. DoorDash and ServiceNow, down $5 billion. All from one article by a macro influencer. That's the power of narrative in this market right now. And overnight, we got a narrative earthquake. Here's the bottom line up front. 4 things you need to know before the bell. Number 1. NVIDIA just reported record revenue of $215 billion. AI demand is not slowing, but the stock is only up 1% pre-market on a blowout quarter. If it can't rally hard on numbers this good, that's a warning sign. Number 2. The Supreme Court just blocked a pillar of U.S. trade policy. Companies are pulling guidance. Aston Martin is cutting 20% of their workforce. Canada says tariffs are here to stay. Number 3. 8 of 11 sectors are bullish at max position. Value is beating growth. International equities have stronger momentum than the U.S. Gold is screaming bullish. The dollar is bearish. Crypto is out. Number 4. Breadth is dangerously narrow. SPY rose 0.84% yesterday. RSP, the equal weight, rose 0.06. The megacaps are carrying everything. One stumble, and this rally breaks. The Supreme Court just blocked a pillar of U.S. trade policy, and the ripple effects are already showing up in earnings calls. Steve Madden, the shoe company, was supposed to give profit guidance today. They pulled it. Their exact words: uncertainties created by the Supreme Court's tariff decision. When a company can't forecast 3 months ahead because of policy chaos, that tells you something. Aston Martin is cutting 20% of their workforce, 600 jobs gone, and they're directly blaming U.S. tariffs for widening losses. Canada's finance minister came out overnight and said flatly, the U.S. is unlikely to lift tariffs. That's not speculation. That's the Canadian government telling their businesses to plan for a prolonged trade war. Asian firms, they're not cheering the Supreme Court ruling either. More confusion, not clarity. But here's where it gets interesting. While tariff chaos is crushing some companies, AI spending is crushing expectations. NVIDIA just reported, and the numbers are staggering. Record revenue of $215 billion. The stock closed yesterday at $195.56. It's trading around $198 pre-market, up about 1%. Volume yesterday was 243 million shares. Massive positioning ahead of the print. AI demand is not slowing. Data center spending remains robust. Jensen Huang, their CEO, is now talking about putting data centers in outer space. That's not a joke. That's the level of ambition we're seeing from the company that powers the AI revolution. This is bullish for tech broadly. If NVIDIA is crushing it, the hyperscalers are spending. But, and this is important, watch the reaction. The stock is only up 1% pre-market on a blowout quarter. The market may have already priced perfection. If NVIDIA can't rally hard on numbers this good, that narrow breadth concern we'll talk about later gets a lot more serious. The rest of tech earnings? Mixed at best. Salesforce reported, and the forecast failed to dispel AI gloom. Trade desk is sliding. Growth slowdown is unnerving Wall Street. Snowflake gave mixed guidance. So we've got tariff uncertainty crushing traditional companies, AI spending defying gravity at NVIDIA, and the rest of tech struggling to keep up. That tension, that divergence, that's what you need to navigate today. This is your 60-second class. Today, VIX term structure. I didn't understand this until I lost money ignoring it. Here's what it is, what it's doing, and why it matters for your trading today. VIX term structure compares today's VIX, the fear gauge for the next 30 days, to the 3-month VIX. It tells you whether traders are more worried about what's happening now or what's coming later. Right now, VIX is at 1808. The 3-month VIX is at 20.36. VIX is below the 3-month. That's called contango. When near-term fear is lower than longer-term fear, it means the market isn't panicking about what's right in front of it. Traders are complacent in the short term, but they're buying protection for later. Contango is generally bullish for stocks in the near term. It signals no imminent crash expectations. But here's the catch. It also means hedging is relatively cheap right now. Smart money uses contango to buy protection before everyone else gets scared. Write this down. VIX below VIX 3M equals contango equals short-term complacency. Now let's check the dashboard. 5 readings. Each one gets the full breakdown. VIX, the fear gauge. VIX closed at 1808 yesterday, up about 1%. That's still in the normal range. Anything below 20 is historically calm territory. Despite all the tariff headlines, despite the Supreme Court chaos, despite earnings uncertainty, implied volatility remains subdued. The options market is not pricing in a major sell-off. This is neutral to slightly bullish. No fear premium being paid right now. But keep this level on your radar. If VIX spikes above 20, the narrative changes fast. VVX, the fear of fear. VVX is at 103.98, down over 4%. The VVX to VIX ratio is 5.75. VVX between 90 and 120 is the normal range. We're right in the middle. The ratio under 6 means VIX options are fairly priced, not expensive, not cheap. If you want to hedge, this is a reasonable time to do it. Costs are fair. VIX term structure, contango check. We covered this in the 60-second class. VIX at 1808. VIX 3M at 20.36. Classic contango formation. Traders expect volatility to be higher in 3 months than it is today. Bullish short-term signal. But contango can flip to backwardation fast when unexpected news breaks. DXY, the dollar index. DXY is at 97.71, essentially flat overnight. No major move. Dollar strength has been a headwind for risk assets and multinational earnings all year. A flat dollar gives equities room to breathe. No new pressure, no new tailwind. Neutral today. Watch for any breakout above 98 or breakdown below 97. Breadth, who's participating? Yesterday, SPY rose 0.84%. RSP rose just 0.06%. Read that again. The index was up almost a full percent. The average stock was flat. The megacaps are carrying the entire index. Apple, Microsoft, NVIDIA, Amazon, Google, they're doing the heavy lifting. The other 490 stocks? Barely moving. This is a bearish divergence. When the generals are marching but the troops aren't following, rallies become fragile. One bad earnings report from a megacap and the whole index could reverse hard. Write this down. SPY up big, RSP flat equals narrow breadth equals fragile rally. Now let's look at what the systematic, rules-based model is telling us. No opinions, no narratives, just data. Regime detection. The quant model reads the current environment as risk on. The growth index is positive at 10.05. The inflation index is bullish at 10.10. The model sees improving growth conditions without runaway inflation. That's the Goldilocks zone for risk assets. Not too hot, not too cold. Performance reality check. The model's year-to-date return is down 1.89%. The benchmark S&P is up 1.66%. The model is currently in drawdown, down nearly 16% from its peak. Even systematic strategies have rough patches. Drawdowns are part of the process. The key question is, does the signal remain intact? Right now, the regime signal says stay risk on despite the drawdown. Current positioning. The model is positioned heavily in leveraged Nasdaq exposure and the remainder in cash. 0 allocation to bonds. 0 to gold. 0 to utilities or healthcare. 0 to Bitcoin. That's an aggressive, concentrated bet on tech and growth. The model isn't hedging. It's not diversifying. It's leaning hard into the risk-on regime reading. Now let's ground ourselves in the actual economic numbers. This is what the economy is actually doing, not what pundits think. Real data. Inflation, CPI. CPI is at 2.39% year over year. Core CPI, which strips out volatile food and energy, is at 2.51%. Inflation is cooling, but it's sticky. We're above the Fed's 2% target, but not by much. The disinflation trend is still intact, but the last mile is proving difficult. Moderately bullish. Lower inflation means less pressure to hike, but sticky inflation means rate cuts might take longer than the market is hoping for. Growth. Real GDP. Real GDP is running at 3.53% annualized. Real final sales of private domestic purchasers is at 2.6%. The economy is growing above its long-term trend. Consumer spending remains solid. Business investment is holding up. This is not a recession economy by any measure. Bullish for corporate earnings. But watch the too hot risk. If growth stays this strong, the Fed may delay rate cuts to make sure inflation doesn't reignite. Labor market. Initial claims. Initial claims came in at 206,000. The unemployment rate is at 4.3%. The labor market remains tight. Claims under 250,000 indicate a healthy job market. Employers aren't doing mass layoffs. Double-edged sword. Bullish for consumer spending. Bearish for those hoping the Fed will cut rates aggressively. Interest rates. The yield curve. The 2-year yield is at 3.48%. The 10-year is at 4.05%. The 30-year is at 4.70%. The yield curve is normally sloped again. The inversion that had everyone screaming recession has largely resolved. Bullish signal. A normally sloped yield curve historically precedes economic expansion. Now let's scan every sector and asset class for momentum. Where's money flowing? Where's it leaving? U.S. equity sectors, all 11. Momentum is bullish on 8 sectors: materials, communication services, energy, industrials, consumer staples, real estate, utilities, and healthcare, all at max position. Momentum is neutral on 3 sectors: financials, technology, and consumer discretionary, half position only. Write this down. Technology and financials, the 2 biggest sectors by market cap, are showing momentum weakness. That's completely consistent with a narrow breadth reading. U.S. equity factors. Value, bullish, max position. Small caps, bullish, max position. Mid caps, bullish, max position. Momentum factor, bullish, max position. Quality, bullish, max position. High beta, bullish, max position. Low volatility, bullish, max position. High dividend, bullish, max position. Growth, neutral, half position only. The signal here is crystal clear. Everything except pure growth is showing bullish momentum. There's a rotation happening beneath the surface. Money moving from mega-cap growth stocks to value, small caps, mid-caps, and quality names. If you're only watching the Nasdaq, you're missing half the story. Global equities. Let's go around the world. Bullish momentum on ex-US developed markets, Europe, Japan, UK, Canada, Australia, Brazil, emerging markets broadly. Neutral momentum on China and India, half position each. International equities are showing stronger momentum than US equities right now. If you're 100% US focused, you're potentially missing the better opportunity set. Fixed income. Bullish momentum on aggregate bonds, intermediate treasuries, investment grade corporate, high yield corporate, emerging market bonds, TIPS, mortgage-backed securities, convertible bonds, preferred securities, short-term treasuries. Bearish momentum on international bonds. The bond market is broadly constructive. High yield being bullish is particularly notable. It means credit risk is being embraced, not feared. Macro exposures, commodities and currencies. Bullish momentum on gold, silver, gold miners, silver miners, base metals, uranium, Australian dollar, British pound, Canadian dollar, euro, all max position. Bearish momentum on US dollar, short signal, max position. Bitcoin, no position. Ethereum, no position. Agriculture, no position. Neutral on oil, Japanese yen, and broad commodities, half position. Write this down. Long precious metals, short the dollar. That's the clearest signal in the entire momentum dashboard. Gold and silver are screaming bullish while the dollar is flashing a short signal. Crypto is bearish, despite all the ETF excitement. Momentum has turned negative on Bitcoin and Ethereum. Now let's look at the discretionary, human-driven macro analysis. The big picture. The strategist remains constructive on risk assets over the next 12 months. The thesis is that we're in a late cycle environment where AI-driven productivity gains and ongoing disinflation create a window for equity appreciation before the eventual secular bear market arrives. Theme 1. Sticky inflation. Inflation is falling, but slowly. Services inflation remains elevated because wage growth is sticky. This keeps the Fed cautious and limits rate cuts. Theme 2. Dollar weakness. The strategist sees the dollar weakening as tariff uncertainty eventually resolves and international growth catches up. A weaker dollar would be bullish for commodities, emerging markets, and multinational earnings. Theme 3. Gold breakout. With real yields still elevated but the dollar weakening, gold is positioned for continued strength. Maximum gold exposure. Theme 4. Bitcoin caution. Despite the crypto ETF excitement, momentum signals have turned bearish. 0 allocation to Bitcoin or Ethereum. The thesis isn't dead, but the timing isn't right. Theme 5. International over US. Following the momentum signals, the strategist prefers global equity exposure over US only. Europe, Japan, and emerging markets offer better risk reward. Now let's put the two approaches side by side. The quant model, positioned heavily in leveraged Nasdaq. Remainder in cash. 0 in gold. 0 in bonds. 0 in Bitcoin. Pure risk on, concentrated in US tech. The macro strategist, positioned in global stocks, not US only. Positioned heavily in gold, maximum allocation. Modest cash. 0 in Bitcoin. Diversified risk on with precious metals hedge. Where they agree, bullish on stocks overall. Bearish on Bitcoin. No meaningful bond allocation. Where they diverge, gold. Strategist is maximum long. Quant has 0 exposure. Geographic focus. Quant is all in on US tech. Strategist prefers global diversification. Leverage. Quant is using leveraged ETFs. Strategist is not. What this means for you. If you're aggressive and believe US tech dominance continues, especially with Nvidia proving AI demand is real, the quant model's positioning makes sense. If you're concerned about narrow breadth, want diversification, and think the dollar is heading lower, the strategist approach provides more balance. Neither is wrong. They're different risk profiles for the same, generally bullish outlook. Here is what you need to know walking into Thursday, February 26th. The overnight story. The Supreme Court tariff ruling is creating real business uncertainty. Companies are pulling guidance because they cannot forecast through policy chaos. But Nvidia just proved AI demand is still explosive. $215 billion in revenue. The market read. VIX is calm at 18. Breadth is narrow. Megacaps carrying the index while the average stock goes nowhere. Contango intact in the VIX term structure. No panic, but no broad participation either. The regime, risk on. Growth is improving. Inflation is contained. Stay long. The momentum picture, precious metals bullish. Dollar bearish. Crypto bearish. International equities showing stronger momentum than US value outperforming growth. Small caps bullish while megacap tech momentum fades. The risk you need to respect. Narrow breadth means this rally is fragile. If one megacap stumbles, the index has no support from the average stock. The opportunity you might be missing. Gold and international equities are where the momentum is. If you are overweight US tech and underweight everything else, the signals suggest rebalancing. The takeaway, a single Substack post moved $50 billion this week. Narrative matters in this market, but data matters more. Know your regime, know your momentum, know your breadth. Trade what you see, not what you hope. I am Mickey.
Hi, good morning. Let's start our wargame analysis. So we know that trading the NASDAQ, we know that we're above NFP Friday, we're below previous month 50%. We're starting to see that we're entering the regiment where we can expect 60% or 70% green days versus 30% red days, right? So from a candle science approach, right, we're trying to see if previous day low or high, which one has the higher probability based off of what the last 2 days have given us, right? And one thing that we can see right out the gate is yesterday closed above previous day high, so we know we're going to get one of the strongest signals that the daily chart gives us from a statistical standpoint, right? So coming over to the candle science, right, we can see that yesterday was a green bullish day, taking out the high and closing above it, and the day before that was a green bullish day as well, right? So coming over to candle science, we're going to select the daily chart, right? We're going to say that 2 days ago was bullish, yesterday was bullish, we closed above the high, right? And so now we can see that there's an 81% probability of taking out previous day high, and there's a 21% probability of taking out previous day low. All right, so let's mark that up, 21 and 81. Right? So in the last 20-something years, when we've done these two signatures, it was more likely 80% of the time that we did that. So now let's go get our reversal data to see how far our statistics say we can go to the upside. Right, so right out the gate, we can see that for the 30th percent reversal zone, right, we can go, it's around 25 basis points. So we're going to go click on that. And we're going to set our green box around 25 basis points. And that's going to be the bottom portion of our 30th to 50th percent reversal zone. So now we're going to go look at the 50th percent reversion, which is at 0.43. Which is right here. So we know that that's a pretty narrow view. Let's make this a little bit bigger so I can get more refined with it. All right, we can see that 50% of the last 20 years, like when we've had two bullish days like this, that 50% of the time it would go up to 0.43 and then reverse, and the other 50 would go even higher. All right. So now we're going to come over here and figure out where our 70th percentile reversal zone is, and it's at 0.73. Which is right here. All right, so we know that this is the highest probable area. It can go above this red box because there's 30% of reversals happen there, but the 70th percent reversal zone is right here at previous month mid, or previous month 50%. All right, so now we're going to move on to the weekly chart, or the hourly chart. And we can see we hit the high probable targets off of our weekly line right here. That had an 82 and a 73% probability over the last year. And then we're above Sunday and Tuesday, so we're going to lock in the low. All right, now we're going to go into what the actual overnight sessions did, and we can see that Asia was short true broken and London was long true broken. So we know they're kind of mixed, right? So Asia sold off and they bought it up in London, right? And that we broke out to the long side from the 730 to 830 box, right? So now we can move over here and we can put in those if-then statements. So short, true, broken, long, true, broken. And then we broke out long to the 730 to 830 fixed constant. We can see that there's an 82% probability that we go false, meaning that we go up to come down. Right, so we go up to come down, right? And we can see over the last quarter, when we broke out of the 730 to 830 box, right, our 30th percent reversal zone to our 50 is right here. And that our 70th to 50 is right here. And this lasts until 11 o'clock. So we know that this is the highest probable area that we can expect that reversal from. We can see that, right, from a New York 1 distro, right, in the last quarter on a Thursday, we typically move 1.09 between 7:30 and 11:30. All right, let me turn off my magnet. So, like, it's not unreasonable to think that we can't get to the top of that box. Right, but we also know that we've had a quarter of expanding volatility as well. All right, so we know that overnight hasn't spent all that much. It's been 153 handles, which is showing us that volatility is contracting, right? Volatility is contracting, so we don't just expect to get this full range, and we expect, if we do get this full range between 7:30 and 11:30, for us to do mean reversion behavior once we get to the top of it. All right, so now let's turn this off now. And go look at some zones that the market might be interested in if it's going to go up to go down. First and foremost, let's look at the high day, low day, right, of a false versus a true. Right, currently, right, our high days at 1800 and low days at 2030, right? Right, so with the false, we can anticipate both the high of the day and the low of the day to come in after the RTH, right? We can see that there's dominant probabilities for that. And we can also see that, we can see that 1800 does have statistical relevancy for the high of the day, right? But there's more data of making a high day and more data of making a low day in the RTH. So let's go on and put our high day, low day zones in for a long false, and then we'll do a long true. We can see from 0.1 around 0.5 off of Globex Open is the mode to median of when we like to put the high of the day in. And because this can happen in two ways, we can come make the high of the day and then make the low of the day towards the end of the day. We're going to consider that. Or we can make the low of the day in the early AM sessions and then make the high of the day at the end, right? So we're going to put We're not going to like select a specific time frame. We'll just go 930 to 1600. And then we'll know where that typically happens at, right? And then we'll go do the same thing with the low of the day. Right? Low of the day is a little bit more extended from 0.5 to 0.8 to the downside. So we'll put that in there. Negative 0.5 to negative 0.8. And then with the same thing, like we're not going to worry too much about the exact time. We just know that we'll let the live price tell us if it wants to make the high of the day in the morning and the low of the day, or vice versa, right? One clue that it's given us, though, is that that high of the day zone matches with the breakout right here. So this would be a very sensitive area. We also see that candle sign supports us taking out this previous day high right here, right? So that's definitely a good, to sit here and think that previous day high, now we have multiple independent variables stacking. We have candle signs, we have the breakout of New York 1, which is a 730 to 830 range, and then we have statistical high day data pointing to this level right above previous day high. So that's definitely an interesting feat, right? So now we're going to come see, right, what the probability of our retracement zones are. So we know that we have this London OU that's been hit 73 times, 73% of the time in the last quarter, right? And it's on a 1-day miss streak out of a 5-day miss streak, right? We have P12 mid right here. So in a false scenario, right, what is the likelihood of us coming down and hitting the P12 mid, right? And we can see that it's a very, very high probability. However, majority of that probability has it getting hit between 6 and 7 o'clock. And then there's only 11% probability for us to hit it between 9:30 and 9:45, right? We can see that same to be true that the P12 high and the P12 low are left open right now. So what's the likelihood of us hitting that, right? The P12 high has an 81% probability, with majority of the time it getting hit between 8:30 to 8:45 or 9:45 to 9:30 to 9:45. And then the P12 low typically gets hit in pre-market, but if it's going to get hit, like there is a cluster of data between 9:30 and 10:45 for it to get hit, right? So we know that these levels, we're going to pay attention to how price responds around the P12 high, mid, and low, right? And then the only other level to the downside is that midnight open. We can see that midnight has an 84% probability of being hit, but typically gets hit between 8 o'clock hour. But there is data to support it getting hit between 9:30 and 9:45. If we cannot hit these levels by not P12 mid and midnight by 10 o'clock, then we might as well give it up and just stop focusing on those levels. That's the market saying it doesn't want it, which leads us to the second scenario of what we can do. We can do a long true, right? In a long true, we know that we like to put the low of the day in pre-market, and then we come put the high of the day. That's a scenario. Or we can put the high of the day in at the end of the day. If we put the high of the day in at 9:30 to 10:30, we can anticipate a new low of the day, especially since we've only moved 153 handles at the end of the day. So it's like this scenario where we made the low of the day already, which is unlikely because it was at 20:30, right, would match with the end of day high of day. And this high of the day between 9:30 and 11 o'clock would match with this low of the day data, right? Especially since the range that we put in overnight. All right, so this would be a simple day. I'll use the 4-step reversal at 9:30 to 10:30. I will definitely be paying attention to, as we get around P12 mid and midnight, do we bounce, right? Or do we continue to sell off and come down to previous day mid and P12 low? All right, so that's what I'm looking for. Let me fix this. And obviously the higher probability is to come up to come down. And then we definitely see that volatility is contracting, right? So the ranges are getting smaller. We've been seeing that on the 10-day median range. We see that we can't spend our quarterly distros within the session. So we know that like we can expect New York 1 not even to have to spend the whole thing. So I'll do, if 930 gives me sells, I'll take it down to cash flowing targets, right? To P12 mid, possibly midnight. It depends on what the live price signature shows me and how, if I can mitigate my risk. If we can take longs off of 930, I'll be way more aware that, previous day high is a high probability area along with this area right here at 25,510. But I'll be quick once we get into this area to take profits and just be done trading for the day. We'll use a 4-step reversal, and hopefully this helps. If you want to see us live trade, like we trade every day in the Discord for most of the sessions. So with that being said, have a great day. Later.